Say thank you very much, Dr. Nambiar, for joining me. Firstly, we can see the market is ran and the updates for the recent US market performance. How did the aggressive unwinding the carry trades contribute to the sharp rally of the yen against the dollar? And what does this suggest about global investor sentiment towards all the risks?
I think Japan has a long tradition of having its interest rates at zero, near zero. And it recently raised its interest rates 15 basis points, which put a huge dent on carry trade. Carry trade is where you borrow from somewhere where your funds are cheap and then you invest them elsewhere. So that meant that it became, and usually investors would invest in US Treasury. But with the rate, with the yen going up, this was not profitable anymore. And therefore, speculators have been unwinding their position. It's not anymore profitable. With the yen going up, the cost of capital goes up. So it's no longer possible to buy cheap from Japan, funds from Japan, and invest them elsewhere where you can get a higher return. So this is one of the culprits which has exacerbated the problem.
And talking about the situation here and also considering the sell-off in big tech following the weak US payrolls report, Dr. Nambiar, what does this indicate about the market's reliance on tech stocks as a barometer for economic health?
Oh, tech is a very big part of the not just the US economy, but of the stock market, and it runs into financial markets, etc. So as you have been mentioning, with all these big tech companies facing losses, it's obviously had a big impact on financial markets also. You very rightly pointed out what happened with Berkshire, how stocks like Apple, Nvidia, etc., have gone down from between 5 to 6%. Earlier on, the story was that Gen AI would be unfolding. It would be picking up, and there would be a big boost for the tech sector. But the figures that have been coming out recently and the possibility of a recession cut into this story. I mean, this story no longer becomes tenable or valid. With a recession, you're not going to see the same kind of demand for AI as you would have thought would have happened. And also, and this is a point that needs stressing, the prices of these tech companies were running far ahead of their profits. So quite naturally, the negative sentiment plus the fact that prices were running ahead of profits led to a pullout from these counters.
All right, Dr. Nambiar, you have just shared from the recent UN against the dollar. It's not profitable when it's yen. It's higher against the dollar, and we can see there's an increase in the capital costs from the funds. We can also, from investment from Japan, it's going to cost a little bit more. And you also have touched on the tech stocks in the market reliance. And we want to talk about also on the Fed's potential rate cut. In the light of Federal Reserve's potential rate cut in September, how might this affect investors' confidence and the overall stability of the US financial markets?
Probably too much fear has been embedded in all that has been going on recently. But be that as it may, it's not likely that you will see the Fed revising its rates in the next week or couple of weeks. That happens only at a time of emergency, say at the time when there was COVID. So we'll have to wait until September before the Fed can take any corrective action. And I think it would be fair to assume that this time around there would be a cut in rates. You would have to balance the story. You would have to do, rather than focusing on inflation, US Fed would now have to look at the growth potential and trying to maintain or trigger the growth potential, for which it would have to get into a rate cut. And I think that would be able to bring about some investor confidence. So yes, the Fed would have to undertake a rate cut, but I think too much is being made of the fear of recession. You probably won't end up at a recession, but in order to improve the growth story and to revive investor confidence, I'm quite sure that you would see a rate cut in September.
Talking about global stock bloodbath, you also want to touch on the Asian markets, especially on the Japan's Nikkei market. What are the broader implications of the Japan's Nikkei's average experiencing its largest one-day fall since 1987, Doctor? And how might this impact the international markets?
I think you see a big rollout as a consequence of what has happened in the US and also what has happened in Japan. So I think all the markets in this region which have some exposure to Japan are going to suffer as a consequence. But I think with the rate cuts in September, the degree of volatility would be contained. And I don't see us going into a more serious dip down.
All right, and Doctor, on the other side of Middle East, how could the escalating Middle East conflicts and their potential impact on crude supplies further complicated the global economy outlook? And maybe we can look at what are some of the measures should policymakers also consider to prevent a potential recession, given the mixed signals from the labor market and even the services sector?
Services hasn't been too bad. Actually, services in the US has posted a rebound. So I think that acts as a counterweight. As you've pointed out, we have a lot of negatives. Manufacturing is not doing too well. Tech is not doing too well in the US. And of course, you have problems coming out of Japan due to BOJ's rate increase. So in the midst of all these negatives, you have one additional factor, which is the kind of volatility that we are seeing, the political volatility that we're seeing in the Middle East. Hopefully, reason will prevail and you won't have a worsening of the conflict there. Because as it is, whatever could happen could have impacts on the oil market. We don't want to see cuts in production or an increase in the price of oil, which could further aggravate the downslide in the US market and therefore global markets.